Welcome to our audiobook chapter on the crash of 1929. In this chapter, we will be discussing the events leading up to the stock market crash, the causes of the crash, and its aftermath. This is a crucial moment in history that shaped the world economy for many years to come. Get ready to learn about the historical events that led to the Great Depression and the impact it had on people's lives. So sit back, relax, and let's dive into the past to understand the present and future. In 1924, money meant gold, and Great Britain was desperate to return to the gold standard. Abandoned in August 1914 as a reality of the outbreak of war, the gold standard before 1914 had meant stable exchange rates and a fluid international economy, with London at the center of the web and the pound sterling the world's reserve currency. The British knew that returning to the gold standard after more than a decade wasn't sufficient to restore Great Britain to preeminence in the mercantile and financial world, but they were certain it was necessary. They were equally certain that if they were to return to the gold standard, they would need the assistance of the United States Federal Reserve. The person asking Benjamin Strong for help was Montagu Norman, Governor of the Bank of England since 1920. Both sides of Norman's family had been bankers, and Norman's maternal grandfather, Mark Collett, had been Governor of the Bank of England in the 1880s. Unlike Strong's family, Norman was financially stable, and Norman was able to attend King's College, which he flunked out of after a single year. Norman joined his father's firm, Martin's Bank, in 1882, becoming a partner in 1900. Surprisingly, given his success as a banker, Norman displayed an astoundingly fragile grip on emotional stability throughout much of his life. Regardless of his psychological trials, Norman was elected a director of the Bank of England in 1907 while continuing his employment at Martin's Bank. However, from 1911 to 1913 he didn't work at all, because he was suffering from what was likely a bipolar crisis. This breakdown established a pattern. At moments of emotional distress, Norman would abruptly abandon work for months at a time to travel in disguise and under a pseudonym. Despite this, or maybe because of it, he left Martin's and joined the Bank of England full-time in 1915. By 1920, he was governor. Norman, profoundly troubled of mind, and Strong, profoundly weak in body with tuberculosis, became best of friends once they were thrown together by their work at their respective central banks. The two would vacation together, alternating between Manet and the south of France, and maintain a constant stream of letters when apart. In 1924, Norman was the greatest advocate for Great Britain's return to the gold standard, with the exception of the Chancellor of the Exchequer, Winston Churchill. To accomplish this, the Bank of England would have to entice gold to return to the country, and Norman knew how to do so. Just as the Bank of England had raised interest rates in 1907 to make England a more attractive place to deposit gold and keep it from leaving for San Francisco, Norman, as head of the Bank of England, now asked Strong to reduce the Federal Reserve's discount rate to make London a relatively more attractive place to deposit gold. The mechanism was so strong and Norman's longtime goal so well known that when the Fed's discount rate had temporarily exceeded that of the Bank of England in 1923, causing gold to flow into American vaults, Strong had felt forced to rationalize the higher US rate in an apologetic letter to his friend. The results: the American stock market lost ground each of the next 5 months and fell 16.4% during that period, convinced me that our action was required. Of course, we must not close our eyes to the bearing this may have upon Europe. Having shown a willingness to cut the discount rate when it could in 1921, and anxious to help the friend Strong had felt the need to apologize to a year earlier. Strong and the New York Fed cut the discount rate by 0.5% in May 1924, and then cut again 42 days later on 12th June, and again in August, in an effort to make England a better place for the world to deposit its gold. By August 1924, the Fed had cut the discount rate to just 3%, matching the lowest discount rate the Fed had ever set, as well as the rate in effect when the United States entered the war. It was lower than the 4% rate that stood when the war ended. In short, it was an emergency rate, expected only during the direst economic circumstances. While the Fed would raise the rate by 0.5% in February 1925 in response to domestic considerations, that move was accompanied by a 1% increase by the Bank of England, thereby increasing the interest rate differential to again strengthen the flow of gold headed toward London. In May 1925, the goal was achieved. Britain returned to the gold standard with the passage of the Gold Standard Act of 1925. The original charter of the Federal Reserve spoke to its responsibility to America and Americans. It was silent as to any responsibility to help another country return to the gold standard, but cutting interest rates was easy. Unfortunately, the Fed wouldn't show a symmetrical willingness to endure the hard work of raising rates or tolerate their vicissitudes even in the face of the manic stock market speculation these lower rates generated, until well after this cowardice had led to the unrestrained speculative frenzy that ignited the Great Depression. Perversely, and at Strong's insistence, the Fed would again cut rates 3 years later, with the lone goal of helping the British-American interests be damaged. When the Fed cut interest rates in 1924, it predictably ignited a furious stock market rally. With money now cheap, stock ownership was easier to finance as well as more attractive in comparison to owning bonds, and the stock market went on a fabulous run, with a 7.2% gain in June when the discount rate was cut to a 6-year low of 3.5%. A gain of 6.0% in July. And a gain of 3.0% in August, when the rate was cut again to just 3.0%, matching its lowest rate ever. The rally continued with gains of 7.0% in November and 8.2% in December, as rates remained low and as Coolidge established himself in office. At the end of 1924, the Dow had gained 26.2%, the best annual gain since the end of the war. Born on Independence Day in 1872, Coolidge came from a prosperous, but not wealthy family. Coolidge and his shopkeeper notary public father shared a frugal nature and an abiding respect for the personal industry. As president, Coolidge was confident that sound national economic principles that were consistent with personal frugality and honesty would lead to prosperity. He genuflected to both management and labor when he said, "The man who builds a factory builds a temple, the man who works there worships there, and to each is due not scorn and blame, but reverence and praise. The Coolidge prosperity would continue in 1925 with stock market gains of 2.2% in January and 2.8% in April, followed by a colossal rally of 8.3% in May, the best month the stock market had had since 1920. The Dow gained another 5.5% in August, and then bested May's performance with a gain of 9.1% in October. The Dow would end 1925 with a gain of 30.0% as it closed at 156.66. The 2 years of 1924 to 25 resulted in a 64.0% gain for the Dow, its fourth best 2-year stretch to that point. Those few who worried about the market were focused on the frenetic pace of the rally. In May, Benjamin Strong expressed his own concerns, citing the ever-present menace of the stock exchange speculation. Privately, he was frustrated that his efforts to help his friend in London was resulting in the unwanted side effect of excessive stock market speculation. In a letter to Norman, Strong complained, "It seems a shame that the best sorts of plans can be handicapped by a speculative orgy, and yet the temper of the people in this country is such that these situations cannot be avoided." Strong understood how dangerous such an orgy was, but as his health deteriorated, he would not be able to control the nation's speculative urge. Strong wasn't the only one in the government worried about the dangers of unrestrained speculation. Herbert Hoover became Coolidge's Secretary of Commerce after a distinguished career in business that had left him well-traveled, well-known by international business leaders, and splendidly wealthy. After an even more impressive stint leading the effort to provide food aid to a devastated post-war Europe, Hoover was famous to the world at large. In July 1920, the New York Times named him one of the 12 greatest American men for his relief work. In 1925, during his term as Commerce Secretary, and as the stock market was climbing furiously thanks to a Fed discount rate of just 3.5%, Hoover turned to his friend Adolph Miller. Miller was one of several governors of the Federal Reserve. The Federal Reserve had, and still has, several governors in addition to the presidents of the regional banks and is led by the chairperson, while the Bank of England had a single governor, who served as its most senior official. Montagu Norman was that single governor during the 1920s. Hoover urged Miller to get the Fed to limit credit. After a single increase in the discount rate to the current rate of 3.5% on the last business day of February 1925, the Fed hadn't budged. Likely because a 4.9% loss in the stock market in March was believed to have resulted from February's rate increase. Since the founding of the 12 regional Federal Reserve banks, each had been able to independently set the discount rate that prevailed in its particular region. In an era when the capital was relatively immobile, this independence was intended to draw money to those portions of the country that needed it, for example, to finance agriculture. As 1925 ended, every one of the regional banks had their discount rate at 4%, with the exception of Strong's New York Bank, which held its discount rate at just 3.5%, despite his concerns about stock market speculation. Strong finally raised the New York Fed's rate to 4% in January 1926 because, as he explained, he have had a dangerous speculation develop in the stock market with some evidence that it is extending into commodities. Strong's hawkishness didn't last long. After a broad-based sell-off in March 1926, when the Dow fell 9.1% and lost ground 17 of 27 trading days, he again gave way to his profound inability to stomach bad news from the stock market, even when it had gained 117.7% in the previous 5 years. He cut the New York Fed's discount rate back to 3.5% on 23 April 1926, though every other regional Fed bank held its rate steady at 4%. At about the time Strong cut rates in New York, he left for England. After he returned in October, he was stricken with flu and then pneumonia, dangerous conditions for a man already weakened by tuberculosis. Strong would leave for Colorado Springs to convalesce and would be absent from New York for a full year at a time when interest rates were historically low and speculation continued to run dangerously hot. After the Dow had consolidated the gains of 1924 and 1925, it rallied just 0.3% in 1926, though the financial outlook for 1927 was rosy. One newspaper on 1st January described the extremely favorable diagnosis of the existing position. Economic growth was strong if volatile. The stock market was also strong. Even when it fell back, it recovered its losses reliably and quickly thanks to low interest rates. Conditions certainly didn't call for the Fed to cut rates further. Conditions were very different in Europe in 1927, as gold once again was leaving the vaults of European central banks. Normally those central banks would raise interest rates to slow the exodus or, at best, reverse it. Instead, they were all trying to manage their currencies in relation to other European currencies, as well as to the dollar, in order to attract gold deposits while avoiding rate hikes that would inevitably slow their economies. For some time, Montagu Norman had been pressing for a meeting of the principals of the 4 leading central banks. He wanted to discuss their mutual dilemma, and in June Strong called such a meeting in the hope that they could reach a common solution and ease the tension developing between England and France. No record was kept of the proceedings, and the participants refused to confirm that they were meeting, but once their conference broke on 7th July, they left New York together to report to the Federal Reserve Board in Washington, D.C. 3 weeks later, the rate-setting arm of the Federal Reserve, the Open Market Investment Committee, met and was joined by Strong. The committee's focus was obvious from the minutes, which said, the most important consideration was undoubtedly the fact that the differential between the rates in New York and the rates in London was not today sufficient to enable London, and therefore the rest of Europe, to avoid general advance in rates this autumn unless rates here were lowered. The minutes further confirmed that the committee knew that helping London might have dangerous consequences at home. It was felt that the only possible adverse development resulting from a general lowering of discount rates would be in the speculative securities markets, but that this possibility should not stand in the way of the execution of an otherwise desirable policy. So the Fed ignored the danger and lowered rates in the United States. Even though money was plentiful and the economy was robust, they did so to help Strong's friend in London, knowing that they risked creating a speculative bubble. Adolph Miller was the only member of the Federal Reserve Board to dissent. He would later call the Fed's course of action the most costly error committed by it or any other banking system in the last 75 years. Economist Liaquat Ahmad would call Strong's supremely misguided course the spark that lit the forest fire. In a bit of misdirection, Strong convinced the Kansas City Regional Bank to serve as the vanguard for his scheme, with their first discount rate cut coming on 29 July 1927. 7 of the regional banks, including New York, followed during the first half of August, though Philadelphia, Chicago, Minneapolis, and San Francisco refused to participate. Despite the history of regional bank independence, in September the Federal Reserve Board, in an unprecedented move, forced the 4 recalcitrant banks to lower their rates, matching the rate that Strong had dictated from New York. The Fed also entered the public market, buying government securities in huge volume, driving interest rates even lower and leaving the sellers with cash they used to buy stocks. By one measure, Strong's plan worked. Gold did flow out of the United States in substantial quantities as it searched for the more attractive interest rates that were now available in Europe. But as one professor from the London School of Economics described it a few decades later, from that date, according to all the evidence, the situation got completely out of control. Miller was not the only person in government who feared the course Strong had plotted. Hoover also recognized the danger, and he urged President Coolidge to intercede, calling Strong a mental annex to Europe. But Coolidge was disengaged, and he refused, placing his confidence in Andrew Mellon, who was entering his 7th year as Secretary of the Treasury and who had just been quoted as saying, "The stock market seems to be going on in a very orderly fashion, and I see no evidence of over-speculation." If Hoover had heard Mellon make this observation, he might very well have replied, "Not yet, but just wait." A total of $500 million in gold left the United States in 1927. As a result, money for short-term loans to businesses and stock market investors, call money, the same call money that had gotten so expensive at the depth of the panic in 1907, became scarcer as the outflow of gold shrank the money supply and kept banks from filling the demand for capital. Despite the decrease in the discount rate, this temporary scarcity in call money drove up the cost to those seeking to borrow, which meant that as 1927 ended, the cost of call money was at its highest level of the year, 4.4%. This spread between the discount rate and the amount stock market speculators were willing to pay for call money created a new and supremely dangerous phenomenon. Prior to this moment, banks generally had been the providers of call money. But beginning in 1927, individuals, foreign entities, and American corporations, disappointed by the measly interest rate paid by banks that could get all the money they needed cheaply from the Fed, put their money into the call market. At the end of 1926, call loans had totaled $3.3 billion. 1 year later, they totaled nearly $4.5 billion. Call money available to stock speculators would explode over the next 2 years, driven by a differential in interest rates, and this expansion in call money would fuel a legendary stock market rally. Calvin Coolidge decided that someone else would have to preside over whatever came next. In August 1927, while the president was vacationing in South Dakota, he summoned reporters and handed each a slip of paper with a single sentence, "I do not choose to run for president" in 1928. Coolidge was leaving office even though he was governing during an age of astonishing affluence. Despite having a devout capitalist leaving the presidency, the stock market continued its advance in large part due to low rates and the flood of call money. The Dow closed above 200 for the first time on 19 December 1927, gaining 21.8% during the last 6 months of the year thanks to Strong's latest efforts to help Europeans. It would close on 31 December 1927 at 202.40, an all-time high, with a gain of 28.8% for the year. While new lenders were financing the stock market speculation through the call money market, there were also new vehicles for speculators. The investment trust idea was not new. Small investors in England and Scotland had been pooling their small investments into larger ones, managed by investment companies, since the 1880s. The manager would hold stock in several hundred companies, many more companies than an individual investor of modest means could hope to invest in, and provide diversification along with the promise of superior returns thanks to professional management. When the concept made its way to the United States, it went by the august name of the investment trust. Despite the logical value of investment trusts, relatively few existed in the United States before 1921. One observer put the number at about 40. One reason there were so few investment trusts was that it took World War I and Liberty bonds to turn Americans of modest means into investors. Fully half the bonds sold had the lowest possible face value, $50. Another third had a face value of just $100. After the last Liberty bond issue was floated in October 1918, the majority of American households were investing, and after Harding's return to normalcy, many of these small investors turned from bonds to stocks early in the 1920s. Others, having watched the stock market do so well in 1924 and 1925, were similarly enticed to join, and by 1926 another 139 investment trusts had been created. As the stock market continued making new highs, another 140 investment trusts were created in 1927 alone. The growth in investment trusts wasn't due purely to their willingness to accept investments of just a few dollars. It was driven by the economics of the trusts themselves. The sponsor of the trust would receive a management fee in perpetuity and could enjoy other fees, such as commissions for buying and selling stock on the trust's behalf. Driven by the sort of advertising the Treasury Department had perfected when selling Liberty bonds, investors' thirst for investment vehicles in the mid-1920s meant the pools were often selling for more than the cumulative value of the stocks they contained. An investment trust could assemble a pool with $50 million in stock and sell shares in it for $55 million, with the difference going directly into the sponsor's pocket. The growth in investment trusts was understandable, given the economics. It's only astonishing that more of them weren't created. The number of assets managed and the premium that a particular investment trust enjoyed were a function of the prominence and reputation of its sponsor. Advertising helped, but one certain way for a sponsor to enhance its reputation was to hire men of letters. University economists in the 1920s washed onto the shores of Wall Street in a migration that would be repeated in the 1980s by Hein Leland and Mark Rubinstein, and 2 decades after that by David X. Lee with his Gaussian copula function. The stock market would pay the price each time. The famous Princeton economics professor Edwin Kemar, known as the Money Or, became one of these reverse refugees when he joined the board of investment trust sponsor American Founders Group, along with another well-known economist, Rufus Tucker. Another sponsor went one better, hiring 3 distinguished economists, one each from Stanford, Michigan, and Yale, advertising that in the same way that diversification of stocks was good for investors, diversification of the points of view generated by academics from 3 different institutions was good as well. Thank you for listening to our audiobook chapter on the crash of 1929. We hope that you have gained a deeper understanding of the events leading up to the stock market crash, the causes of the crash, and its aftermath. This chapter is a crucial moment in history that impacted the world economy for many years to come. Remember, it's important to understand the past to make informed decisions in the present and the future. Don't forget to subscribe to our channel for more historical audiobooks and leave your comments and feedback in the section below. Thank you for listening.